Welcome to ActioFin. This is the first episode of our management control series. Over the next few minutes we will answer a question that confuses a lot of business owners and even finance staff. What does a management controller actually do? By the end you will see why management control is not bookkeeping, not auditing, and not just building reports. It is the discipline that turns raw numbers into better decisions. Here is our plan. First, we separate management control from financial accounting because people mix them up constantly. Then we walk through the control cycle, the 4 steps that repeat every month. We look at what a controller actually measures. We follow a real-style example, a small manufacturer called Northgate Tools. We cover the mistakes that quietly destroy a controller's credibility. And we finish with the points worth remembering. Let us start with a clean definition. Management control is the continuous process of setting targets, measuring actual performance against those targets, and helping managers act on the gap. The key word is continuous. Financial accounting tells the world what already happened, once a year, for shareholders and the tax office. Management control works inside the business, every month, every week, so that decisions can still change the outcome. Think of it as steering the car, not reading the scoreboard after the race. This table makes the contrast concrete. Financial accounting serves people outside the company, investors, lenders, and the tax authority. It follows strict standards like FRS 102 or IFRS, it is annual, and it is certified. Management control serves managers inside the company. It can break every formatting rule if that helps a decision. It is monthly or even daily. And where financial accounting asks what happened, management control asks what we should do next. Same numbers underneath, completely different purpose. It is worth understanding how this role has changed, because the stereotype is out of date. The old-style controller sat in a back office, policing budgets and saying no, the bean counter. The modern controller is a business partner. They sit beside the operations team, the sales lead, the production manager, and help them make better decisions in the moment. The numbers are the same, the posture is opposite. Instead of reporting on managers after the fact, a good controller is in the room before the decision, asking the question the numbers raise. That shift, from scorekeeper to co-pilot, is the single biggest change in the profession. And it is why the job now demands communication as much as spreadsheets. For control to be fair, you must match each number to whoever can actually influence it. That is what responsibility centers do. A cost center, like a support department, is judged only on the costs it controls, never on revenue it cannot touch. A profit center, like a branch or product line, owns both its revenue and its costs, so it is judged on profit. An investment center goes further and is held to the return it earns on the capital tied up in it. Get this wrong, blame a cost center manager for a sales shortfall, and you destroy trust and motivation. Match accountability to control, and the whole system feels just, which is what makes people act on it. Every management control system, in every company, runs the same 4-step loop. Step 1, plan, you set a budget and clear targets. Step 2, measure, you collect the actual results, and speed matters more than perfect precision. Step 3, compare, you put actual against plan and you analyze the difference, the variance. Step 4, act, managers decide and adjust. Then the loop starts again. A controller who only does steps 1 and 2, plan and measure, is producing reports nobody uses. The value lives in compare and act. Before we list what to measure, one word on rhythm, because it decides whether anyone uses your work. Good management control lives on a monthly heartbeat called the close. The discipline is to get the actual figures onto a manager's desk within about 5 working days of month end. Why so fast? Because a decision taken in week 1 can still change the result, while a decision in week 4 cannot. This is why controllers chase the fast close. A report that is roughly right and early beats a report that is exact and late. Precision to the last penny is a comfort for accountants, speed is a weapon for managers. Build your month around that idea and half the job is already won. So what does a controller actually track? For families of indicators. Profitability, but broken down, not just the total, but by product. By client, by site, because the average always hides winners and losers. Cost behavior, splitting costs into fixed and variable, which is the single most useful distinction in the whole discipline. Cash and working capital, because a profitable company can still run out of money. And operational drivers like volume, yield, and utilization, the physical numbers that explain the financial ones. Let me dwell on that cost behavior split, because it is the foundation of everything that follows in this series. Variable costs move with volume, raw materials, packaging, sales commission. Make one more unit, you spend a bit more. Fixed costs stay put whatever you sell, rent, salaried staff, insurance, software. Why does this matter so much? Because once you separate them, 2 powerful numbers appear. First, your break-even point, how much you must sell just to cover the fixed costs. Second, the contribution of one extra sale, price minus variable cost. The cash each unit throws off toward those fixed costs and then profit. Managers who grasp this stop pricing by gut feel. We will use this split in every remaining episode, so make it second nature now. Here is the core reason management control exists. Imagine a company reports a 9% net margin. The owner is reasonably happy. But that 9% might be one excellent product earning 30% quietly subsidizing another product that loses 10% on every sale. The financial accounts will never show you that. They are correct, certified, and useless for that decision. Management control breaks the average apart, and suddenly the right action is obvious: fix or drop the losing product. Let us make this real with Northgate Tools, a small engineering firm with £4.2 million of revenue. It sells 2 lines. Standard tools bring in £3 million and look healthy. Custom tools bring in £1.2 million, and they are the founder's pride and joy. On the statutory accounts everything looks fine. But the founder has never seen the margin of each line separately. That is exactly the gap a controller fills. When the controller finally splits the lines, the picture changes completely. Standard tools earn a 28% contribution margin. Custom tools lose 6% on every order. The blended average, 15%, looked perfectly comfortable and was hiding the truth. The custom line was draining about £72,000 of cash a year. Nothing illegal, nothing visible in the statutory accounts, just an expensive blind spot that one analysis exposed. And this is the part that defines the job. The controller did not just hand over a depressing slide. She proposed 3 actions: reprice custom orders to cover their true cost. Set a minimum order value so tiny jobs stop losing money. And keep the custom line only for strategic clients who also buy standard tools. The founder kept his pride and joy, but on healthy terms. Group margin moved from 15 to 21% in 2 quarters. That is management control doing its job. Encouraged by the product analysis, Northgate's controller cut the data a second way, by customer. The pattern repeated. The top 20% of clients generated about 140% of total profit. while a long tail of tiny accounts, mostly demanding one-off custom jobs. Actively lost money once you counted the time spent serving them. This is the famous whale curve, and almost every business has one. The lesson is not to fire small customers blindly, it is to serve them differently, minimum orders. Standard products, self-service, so they stop draining the profit the best clients create. One dataset, 2 cuts, 2 strategies. One last point before the mistakes, and it underpins everything. None of this analysis matters if people argue about the numbers themselves. If sales quotes one revenue figure, finance another, and operations a third, every meeting dissolves into whose spreadsheet is right. So the controller's quiet, unglamorous first job is to build a single source of truth. One agreed set of definitions and figures that everyone trusts. It is not exciting work, but it is the foundation. Once nobody disputes the numbers, the conversation can finally move to what the numbers mean and what to do. Which is where the controller earns their value. Before we wrap up, the 3 mistakes that quietly end a controller's credibility. First, late numbers. A flawless report delivered 3 weeks after month-end is worthless because the decision window has closed. Fast and roughly right beats slow and exact. Second, showing a variance with no recommendation. That makes you a narrator, not a controller. Always attach a proposed action. Third, death by detail. 40 indicators on one page means nobody acts on any of them. Lead with the 3 numbers that actually change a decision. Let us bring it together. Management control steers the business while financial accounting scores it after the fact. The work runs as a loop: plan, measure, compare, act, and the value is in compare and act. Your most powerful habit is breaking the average apart, by product, client or site, because that is where the decision hides. And never deliver a number without an action beside it. Get those for right and you are already ahead of most finance teams. In the next episode we go one level deeper, into cost accounting, direct and indirect costs, cost centers. And the difference between full costing and variable costing, the toolkit behind every number you just saw. You will find this full course, with calculators and practice cases, on ActioFin.com. See you in episode 2.